Real estate is a risky business. So before you enter a deal, you better understand all the risks you're involved in. Identify all the risks and define how you treat them. When I say treat, it means you can accept a risk, or you can transfer a risk, meaning insurance, or you can mitigate a risk. And in the end, you might come to the conclusion that the risk is too large to accept and you cannot transfer it, so you might back out of the deal. That's why it's really important to understand the risks before you get into the deal. Let's go through a list of common real estate related risks, so you can take this list as a guideline to assess the risks for your project. The first area would be political risks. Think of failing states. Think of Sri Lanka or similar economy collapsing. Think of Lebanon, for example. We had a couple of cases in the last couple of years. We will see a couple more in the next years. Think of war, Ukraine, there are lots of examples. So assess how stable a region or a country is and take that into consideration whether you want to invest in that country at all. Now, there are also less severe political risks. One can be how a country treats foreigners who own real estate in that country. Or another topic in this area would be taxes. So a change in the taxes regarding real estate, transfer of real estate, buying real estate, or anything treating the revenues you get out of real estate can have an impact on the market itself and how profitable your investment will be. Or think of a smaller unit than a country, that can be a city or a town, that restricts short-term rental, for example, which impacts the profitability of your property, or that forces you to implement certain restrictions, for example, energy efficiency to fight climate change. And do keep in mind the way a country treats the foreigners in terms of property ownership impacts the market price, even if you're not a foreigner in that country. When there are less foreigners who can buy a property, there are less people who can buy the property. That lowers the prices in the market. So changes in the regulations, how you can finance your home, how much equity you have to bring in, or also the fees and taxes involved in transferring ownership of a property are common measures by regulators to lower the risk of a bubble in the real estate market, and they can negatively impact the property you own. Another area of risk is related to natural disasters. So that can be earthquakes, volcanoes, heavy rain, flooding, anything like that. In the last couple of years, we've seen a big rise of natural disasters, and with climate change, we will continue to see more and more of these. So if the property you're looking at is in a potential flooding area or impacted already by climate change heavily, you might want to consider this risk as well, and how can you deal with that. Also consider the rising sea levels and hurricanes. For example, Florida will be underwater in a couple decades, so you might not want to buy something. Better to rent here, because in a few years it will all be underwater. Another area of risk is financial risk. Think of, for example, interest rates. In the last year, we've seen interest rates picking up massively, and that is like an earthquake on the financial markets. What was profitable before might not be profitable now. And a lot of people cannot afford the mortgage anymore, or they could not afford to buy it at the price you were hoping to get. So if you're looking at buying something to rent it out, an increase of the cost of capital, as we've seen by the rising interest rates, can really ruin the business case. Some people call this also the Airbnb bust. Another thing to look out for is foreign exchange rates. If you're investing overseas or in a different country with a different currency, the changes in these FX rates can impact your investment as well. And these changes over the long run can be quite significant. For example, if your asset is in one currency and your mortgage is in a different one, a change in the FX rates can increase or decrease the equity you have in that property quite significantly. Then also consider the market risk. Market risk meaning supply and demand. There can be a significant change in either one of these sides. So more supply can mean there's too much supply for the demand and prices go down. Or the demand is breaking off and no one wants to rent your property anymore. Either way, that can be quite bad for your property. And then purchasing related. The purchase itself might be illegal if, for example, you're a foreigner and it's not legal for you to buy. Or the seller does not even outright own the property. And depending on the jurisdiction you're acting in, there might not be much protection for you on this case. It might also be that there are some legacies related to this property and the land. Think of toxic waste in the ground or something like that. And you as an owner might end up being liable to remove these, even though you do not know anything about the history of that property. And if you decide to construct or have someone construct a building for you, that brings a whole new universe of risks with it. The developer might go bankrupt. There might be issues with delivery timeline, with delivery quality. And all of these risks are quite real. Developers go bankrupt every single day. The quality issues are nearly guaranteed. And delays in timeline are very, very common. So do consider how you deal with all these factors beforehand. And especially when it comes to the quality of the construction, the risks don't end with the handover of the construction or with the end of the warranty period. These construction risks stay with you for many, many years. So do consider all of these areas before you sign, and I wish you all the best with your real estate project.